The stock of Meta platforms has experienced a true roller coaster ride over the last 1.5 years. The stock declined as much as 76% from its previous peak before more than doubling from the bottom in November. Now Meta, the company formerly known as Facebook, reported its annual results recently. And while there were many super interesting data points in this report, one number stood out, and it is arguably the most important metric that Meta investors need to be aware of. So in this video, we will unpack this part of their report and explain why the current development in this area could easily be misinterpreted and taken as a negative. So without further ado, let's get started. Alright, hey there, my name is Ray Zellman, and you are probably very well aware of the fact that the US big tech companies, Facebook, Microsoft, Google, Apple and Amazon, reported their earnings quite recently. In this video, we will focus on Meta, whose stock was soaring the day after Meta's Q4 results were released. Meta ended the day up 23%, the best daily performance of Facebook stock in nearly a decade. And while there are a lot of things to unpack here, and I might actually do another video on the other key highlights from the most recent report, one number stood out, and I shared this on Twitter as well. Meta wrote in their earnings release, in the fourth quarter of 2022, ad impressions delivered across our family of apps increased by 23% year over year, and the average price per ad decreased by 22% year over year. For the full year of 2022, ad impressions increased by 18% year over year, and the average price per ad decreased by 16% year over year. These two metrics are arguably the most important KPIs for Meta. Usage of the apps, which translates into ad impressions, and ad efficacy, which translates into ad pricing. Now, is this actually good or bad? Well, I think this data point can easily be misinterpreted because I think at first glance this totally looks like a bad development. Users basically get to see more ads, which will lead to a worse user experience, and at the same time Meta is charging lower prices for these ads. And that's why in response to my tweet, another user pointed out that, quote unquote, it reads like they are spamming the platform more to receive the same amount of dollars. Am I missing something? So inspired by this tweet and by a stretchery interview with Eric Seufert, I want to give you a breakdown of the 4 ways that an ad platform like Facebook or Instagram, but the same of course also applies to platforms such as YouTube or TikTok, can increase its earnings, and by doing so explain why the numbers that Meta recently reported, ad impressions up 23% and ad prices down 22%, might actually be a very positive development. And please watch till the end, because I think the last factor that I will discuss helps you truly understand what Meta is doing with their Reels format right now. And before we start, let me just highlight 2 more things. First, ads are Meta's main source of revenue. As of their most recent report, 97% of their revenue comes from advertising. And second, just a little disclaimer, I do own shares of Meta myself, but I have no intention of buying or selling any shares anytime soon. So the first way to increase revenue for an ad company is to simply increase the ad load. The idea is that during any given session, users get to see more ads relative to the actual content of the platform that they actually want to see. So if, for instance, during a 10-minute session on Instagram, you get to see 10 ads, Meta could increase that to 15 and thereby increase its revenue. However, increasing the ad load is not a preferred option for Meta, as there are limits to this. At some point, increasing the ad load will hurt the user experience, and this will lead to an increase in churn or the number of users leaving the platform. Of course, Meta is not releasing exact data on the churn rate they are seeing, but regardless of the exact data, think of the 4 ways to increase ad revenue that we will discuss in this video. This should be Meta's least preferable option. The second option to boost revenue is increasing the reach of Meta's family of apps, acquiring more daily active users and monthly active users. More users would obviously result in more exposure to ads. It's a simple equation. However, Facebook's reach is already absolutely mind-blowing. Meta reported almost 3 billion daily active users in their Q4 numbers, so almost 40% of every human signs into a Meta asset every day. And almost 50% of the world's population, 3.7 billion users, visit at least one of the family of apps products once in any given month. So naturally there are constraints to this growth lever because there are only so many humans that could theoretically access one of Meta's products. I think it is already quite impressive that Meta is still able to increase the number of users. For context, Facebook's much smaller competitor Snapchat increased the daily active user metric by 12 million users in Q4 of 2022, quarter over quarter to 375 million, and Facebook on the other hand increased this metric by roughly 30 million quarter over quarter. Also, when you look at the development of daily active users broken down by geography, you can see that Meta is primarily growing in regions that are, as of now, much less profitable in terms of the average revenue per user compared to the US in particular and other more developed countries as well. The third option involves enhancing the value of their ad offering. Obviously, the more effective their ad targeting, the more money advertisers are willing to pay, as better targeting will increase the return on ad spend. In the past, this was one of the main revenue growth drivers for Meta, and Meta constantly updated and still updates and expands the advertiser tools, including the addition of new ad formats. And they are of course doing this right now as well by adding the Reels format. And this third factor, the quality of Meta's targeting, also explains why Apple's app tracking transparency feature, ATT, was and is such a headwind, estimated to decrease the company's 2022 revenue by about $10 billion. It simply reduces Meta's targeting capabilities by limiting advertisers from accessing an iPhone user identifier, making the targeting less effective. To what extent Meta can pull this lever to drive growth in the future is up in the air in my opinion. The company is certainly making progress and mitigating the impact from the ATT change and investing heavily in AI to collect and analyze data internally. During the conference call, Zuckerberg said, "In our broader ads business, we are continuing to invest in AI, and we're seeing our efforts pay off here." In the last quarter, advertisers saw over 20% more conversions than in the year before, and combined with the decline in cost per acquisition, this has resulted in higher returns on ad spend. You most likely also haven't heard of Advantage Plus. Essentially, it is an AI-driven offer by Meta that allows advertisers to largely rely on automation to find the right audiences for their ads, as opposed to manual targeting that might be prone to human biases and human error. And this brings us to the last and arguably the most important and promising growth driver of Meta. And again, this factor is also fairly straightforward. It's to increase the time spent on Meta's family of apps. Get back to the example that we used earlier in this video. If, say, during a 10-minute session on Instagram, you get to see 10 ads, well, if the average user spends more time on the app, say not 60 minutes per day, but 90 minutes, well, then Meta would have just increased the number of ad impressions by another 50%. And it seems like this is exactly what Meta is aiming for. You can go back and listen to the investor conference calls that were held ever since Meta launched their Reels feature back in August of 2022. And I think what you will notice is that especially more recently, it has become very clear that Meta is very focused on making Reels work to increase the time spent on their family of apps. As this statistic graph here shows, the average time spent per day in minutes on various social media platforms. TikTok is a huge threat to Meta as the AI-driven recommendation system of TikTok is so addicting. And Meta is trying to do exactly the same now, moving in the same direction, in a way moving away from their former social focus. During the Q3 call, Mark Zuckerberg revealed that they see a similar trend at Meta. Reels is incremental to time spent on our apps. The trends look good here, and we believe that we are gaining time spent share on competitors like TikTok. And this is also confirmed by this graph here, which I have shared in one of my previous videos. Now, if you are able to combine factor 3 and 4, so ad efficiency and time spent on the family of apps, you likely have a winning formula. Of course, in the short term, focusing on Reels is eating into Meta's profits, as the format is not as monetizable as their other ad offerings, but Meta's management has frequently highlighted that over time they will get there and that they've been on the same journey before when they established their stories feature in addition to the regular feed. To quote from the Q4 call, The next bottleneck that we are focused on to continue growing Reels is improving monetization efficiency, or the revenue that's generated per minute of Reels watched. Currently, the monetization efficiency of Reels is much less than feed, so the more that Reels grows, even though it adds engagement to the system overall, it takes some time away from feed and we actually lose money. But people want to see more Reels though, so the key to unlocking that is improving our monetization efficiencies. That way we can show more Reels without losing increasing amounts of money. We're making progress here and our monetization efficiency on Facebook has doubled in the past 6 months. And to bring home the point that I'm trying to make here, the fact that ad impressions being up while ad prices are down is actually a very positive sign if you take a longer term view. Let me highlight one passage from the Strategy interview that I recommend you to read in full. If you have a subscription, it's quite a long read, but I think very well worth your time. Quote unquote, "I think this is the most misinterpreted number for digital ad companies, and it's basically been misinterpreted since Google's IPO. For these large companies, growing impressions and the corresponding decrease in price is a very bullish indicator because they can increase the price over time as they improve their targeting and it becomes more valuable." And again, we saw this with stories and the exact same thing happened. We had this big increase in impressions, we had a decrease in price, Wall Street freaked out, and you look back and it's like, what were you freaking out about? This was actually a big opportunity. And I couldn't agree more. Warner Bros. Discovery Chief Executive David Zaslav actually said at an investment conference that the advertising market right now is currently weaker than at any point during the coronavirus pandemic slowdown of 2020. But over time, the ad market will obviously recover and Meta will do very well when ad prices will go up again. At least that's my take. With that, I'll wrap it up here. I recommend you watch the following video next. Take care.